So to continue our discussion on itemized deductions, let us focus on taxes, specifically foreign income taxes paid. So when we say foreign income taxes paid, so these are the income tax due on income generated outside the Philippines. So obviously, you are only liable to foreign income tax if you have an income generated from abroad. When does a foreign income taxes paid become an allowable deduction? So for foreign income taxes paid, it only becomes an allowable deduction for two types of taxpayers. And this includes the taxpayers that has a tax status of inside and outside the Philippines. So which means that if the tax status of a taxpayer is only within the Philippines, the foreign income taxes paid is not an allowable deduction. So, who are these taxpayers that are allowed to claim foreign income taxes paid as an allowable deduction? So, these are resident citizens and domestic corporations. So, again, these taxpayers have a tax status of inside and outside the Philippines. So, for resident citizens and domestic corporations, they have an option on how to treat foreign income taxes paid. So the first option is to treat the foreign income taxes paid as a deduction from gross income. And the amount that is deductible is the actual amount of foreign income tax paid. And the second option is to deduct as a tax credit. So when we say tax credit, it shall be deducted from the income tax due computed based on the Philippine income tax law. And this is subject to limit. So how do we compute the limit if the foreign income tax paid is claimed as a tax credit? So this is our computation of the limit. So we have limit A and limit B. So again, if the foreign income tax is claimed as a deduction, so it means that such income taxes paid is cannot be claimed as a tax credit. And if the foreign income tax is claimed as a tax credit, it can no longer be allowed to be claimed as a deduction. So to better understand the treatment for the two options, let us answer an illustrative problem. ABC Company, a domestic corporation, has the following information in the Philippines and abroad. So the taxpayer is a domestic corporation, so which means the tax status is inside and outside the Philippines. So which means the taxpayer can claim the foreign income taxes paid as either a deduction from gross income or a deduction from income tax due. So the domestic corporation, aside from income generated in the Philippines, also generated income from outside. So the requirement is to compute for the taxable income and income tax due. So first, let us answer letter A. So in letter A, the foreign income tax paid is claimed by the taxpayer as a tax credit. Again, resident citizens and domestic corporations have two options as to the tax treatment for foreign income taxes paid. So the first one is deduction from gross income at the actual amount. So this is the simpler one because there is no other computation as long as we determine the actual amount of foreign income taxes paid. That will be part of the itemized deductions. However, for the second option, instead of being deducted from gross income, it will be deducted from the income tax due as a tax credit. So this is more complicated because we need to determine the limit. And the limit is composed of limit A and limit B. So first, let's talk about limit A. How do we compute for the limit A? So the equation would be total foreign taxable income divided by world taxable income times Philippine income tax. When we say total foreign taxable income, this includes the summation of taxable income from all countries except Philippines, of course, because this is foreign. Then, after we compute the product of this equation, we will compare this against the total foreign income taxes paid. So this is the actual amount of all foreign income taxes paid. Then, whichever is lower, that will be the limit A. And for limit B, same equation as in limit A. However, this will be on a per country basis. Then in each country, we will compare the product of this equation and the actual foreign income tax paid on such country, and we will get the lower amount between the two. Then the limit B will be the sum of the lower amount of all countries. Then the amount to be deducted from the income tax due will be the lower between limit A and limit B. So this will be our tax credit. So let us compute the taxable income. Using case A, the foreign income tax paid is claimed as a tax credit. So let us first determine the taxable income. So starting with gross sales. So the gross sales in the Philippines is 2.5 million, in USA 900,000 pesos, Canada is 500,000 pesos. So the total gross sales is 3.9 million. So we are going to compute for the taxable income on a per country basis because we need the taxable income of each country in the computation of the limit A and limit B. So next is cost of sales. So for the Philippines, 1,360,200,000 for Canada. So the total cost of sales is 1.56 million pesos. Then we determine the gross profit. So the gross profit in the Philippines is 1.5 million. USA is 540,000. Canada is 300,000 pesos. So the total gross profit worldwide is 2.34 pesos. Then after the gross profit, which is the gross income from operation, we look for other income that is also subject to normal tax. And looking at the problem, we have other income including interest income on loans receivable and gain on sale of real property classified as capital asset. So between the two, the other income that is subject to normal tax is the interest income on loans receivable. Because again, this is a passive income. However, this is not part of the list of interest income that is subject to final tax. Because almost all interest income that is subject to final tax are earned in banks. However, this is a loans receivable, so which means this is not an interest income earned in banks. So this will be subject to normal tax. And we have a gain on sale of real property classified as capital asset only in the Philippines. There is no for USA and Canada. And again, this is not subject to normal tax. This is subject to final tax, which is the capital gains tax. So which means we only have one other income subject to normal tax, and that is the interest income on loans receivable. So we're going to add that to our gross profit. So in the Philippines, we have 10,000 pesos, and in Canada 20,000 pesos. So the total interest income on loans receivable is 30,000 pesos. So the gross income from business in the Philippines is 1.51 pesos, in USA 540,000 pesos, Canada 320,000 pesos, and the total gross income worldwide is 2.37 million. So now after this, let's deduct all the expenses. Since we are using the itemized deduction, we are going to deduct all the actual expenses, assuming these expenses are in compliance with the tax rules. So first is salaries expense. Then after salaries expense, depreciation expense. Next is rent expense. Then bad debt write-off. Again, for bad debts, it should always be the bad debt write-off. Any estimated bad debts are non-deductible for tax purposes. Then interest expense. Again, for interest expense, this is subject to limit, and the amount of limit for the interest expense shall be the 33% of interest income on bank deposit. And since we have no interest income on bank deposit, the interest income that we only have is the interest income on loans receivable. So we cannot use this to compute for the amount to be deducted from the interest expense. So since we have no interest income on bank deposit, the interest expense is deductible in full. So this is our taxable income. So after we deduct all the expenses, we can now compute the taxable income for case A. Again, in case A, the foreign income tax paid will be claimed as a tax credit and it will not be claimed as a deduction from gross income. So for case A, the taxable income is 1,223,000 for the Philippines. USA is 394,800. In Canada is 192,200 and the worldwide taxable income is 1,810,000 pesos. So after we have computed for the taxable income for case A, let us compute now the income tax due, specifically Philippine income tax due for case A. So for case A, since this is a domestic corporation, the regular corporate income tax is at 30%. So this will be 30% of 1,810,000 pesos. Because again, since this is a domestic corporation, the tax status is inside and outside. So the taxable income in the Philippines will be 1,810,000 pesos. Income earned inside and outside the Philippines. Now let us deduct the available tax credits for the taxpayer. And we have, first is the prior quarter tax payments. And how much is this? This is the 200,000 income taxes paid in the Philippines. So 200,000 pesos. So we assume that this income taxes paid pertains to the 3-quarter payments during the taxable year. Then the other tax credit would be the CWT or the creditable withholding taxes, which amounted to 120,000 pesos. And another tax credit, since case A, the taxpayer opted the tax credit option for the foreign income tax, we will compute first for the amount that is allowed as a tax credit for foreign income tax, and that will be subject to limit A and limit B computation. So first, let us determine the taxable income of each country. So for the Philippines, we have 1,223,000. For USA, we have 394,800. Canada is 192,200. And the total foreign is the 587,000 pesos. So this is the total of USA and Canada. And why do we total the foreign taxable income? Because this is for the limit A and the per country will be the limit B. So let's start with the Philippine income tax due. Again, the Philippine income tax due in case A is 543,000 pesos, and this is the 30% of 1,810,000 pesos. So first, let us compute for the limit B. So for USA, 118,440 pesos, and this is computed as 543,000 times 394,800 divided by 1,810,000. So that is 118,440. And this will be compared against the actual foreign income tax paid in USA. So that is 100,000 pesos. So this is the amount paid in USA. Then for Canada, the equation resulted to 57,660, and this is computed as 543,000 pesos times 192,200 divided by 1,810,000 pesos. And this will be compared against the actual foreign income tax paid in Canada, which is 60,000 pesos. So this is the procedure for limit B. Then let's proceed to limit A. So for limit A, the Philippine income tax due will be 176,000 100. So this is computed as 543,000 pesos times 587,000 divided by 1,810,000 pesos. And since this is the total of both USA and Canada, this will be compared against the total foreign income taxes paid abroad, which is 160,000 pesos. So that is the total of 160,000 pesos. So now let us get the lower amount for limit B. For limit B, so on a per country basis, in USA, the lower is 100,000 pesos. Then in Canada, the lower between 57,000 and 60,000 is 57,600, which means that the total lower amounts for USA and Canada is 157,660. And this will be compared against the lower amount for limit A, which is 160,000 pesos. And between 157,660 and the 160,000 pesos, the lower amount is 157,660. So this will be our tax credit for case A. That will be an addition to our tax credit. So which means under case A, our income tax still due and payable is 65,340 pesos. So that is the procedure in the computation of limit A and limit B. Now let's proceed to case B. So for case B, instead of claiming the foreign income tax paid as a tax credit, this will become part of the itemized deductions. So starting with the taxable income for case A, since the remaining expense that is yet to be deducted is the foreign income tax paid, so we will deduct the foreign income tax paid for USA and Canada for 160,000 pesos. So that will be 160,000 pesos. Then let's get the taxable income for case B. So the taxable income for case B is 1,650,000 pesos. And the income tax due for case B will be 30% of 1,650,000 pesos. So 495,000 pesos is the tax due for case B. And since for case B, the foreign income taxes paid is already claimed as a deduction from the taxable income at 160,000 pesos. So we only have two tax credits, and that will be the prior quarter tax payments and CWT. So the income tax still due and payable for case B is 175,000 pesos. So this is the procedures on the tax rules on foreign income taxes paid.